Building an online e-commerce marketplace, collecting a slice of every transaction, and sitting back while automated systems gather profit sounds like the ultimate financial high-wire act where you watch millions roll in. On paper, the numbers look incredible. In 2023 alone, American shoppers spent over $1,110 billion purchasing goods across digital commerce platforms. When you open a typical pitch deck or glance at corporate presentations, the nominal gross margins displayed for these digital platforms appear exceptionally healthy, frequently ranging from 40% to 80%. To an outside observer, these metrics create the irresistible illusion of a high-margin, asset-light cash machine that can scale endlessly with minimal incremental cost. However, that high gross profit margin figure is one of the most deceptive financial illusions in corporate finance. While establishing software to connect a buyer with a third-party seller on a platform is straightforward, sustaining a positive net operating cash flow for an e-commerce platform over a multi-year economic cycle is a brutal operational challenge. Across the digital economy, dozens of high-profile marketplace ventures have burned through billions of dollars in venture capital, only to discover that their net profit margins remain anchored near 0% or deep in negative territory. The ultimate truth revealed by audited corporate disclosures is that the process of moving physical packages, attracting digital traffic, and managing operational friction endlessly erodes top-line fees. Welcome to this comprehensive financial breakdown of the business of e-commerce marketplaces. In this analysis, we extract the core operational reality directly from the United States Securities and Exchange Commission Form 10-K annual filings of the dominant marketplace platforms operating in North America. By analyzing audited balance sheets, income statements, and cash flow reports from corporate giants like Amazon, eBay, Etsy, and PDD Holdings, we can move past marketing narratives and unpack the true unit economics, capital expenditure requirements, traffic acquisition costs, and hitting profit engines that dictate survival in modern digital commerce. To comprehend where top-line cash disappears, we must first trace how different marketplace architectures process a transaction and strip away revenue at every stage of the financial cascade. Not all marketplaces operate under the same structural assumptions. Broadly speaking, the North American e-commerce landscape is divided into three primary operational and financial models. The first model is the heavy fulfillment hybrid platform, exemplified by Amazon and Walmart Marketplace. The second model is the pure-play brokerage or light marketplace, best represented by eBay and Etsy. The third model is the fully managed cross-border architecture, pioneered by platforms like Temu under PDD Holdings and Shein. Let us conduct a forensic breakdown of what happens to a $100 transaction in gross merchandise value across these three distinct operating models using real SEC accounting numbers. Consider the heavy fulfillment hybrid model first. When a buyer purchases a $100 item from a third-party seller on a platform like Amazon, the platform does not recognize the entire $100 as its top-line net revenue under standard accounting principles. Instead, it recognizes the fees collected from the merchant. Between referral commissions, which average 15%, and mandatory fulfillment and warehousing services, the total effective take rate collected by Amazon sits between 30% and 40%. Assuming a 35% total take rate, Amazon records $35 in net seller services revenue from that $100 purchase. From that $35 in recorded net revenue, a relentless cost cascade begins immediately. Physical logistics, which includes inward warehouse receiving, robotic sorting, labor wages, truck haulage, and local last-mile door delivery, consumes approximately $17.50. Payment gateway processing fees and fraud protection mechanisms take away $3.20. Software engineering, server infrastructure maintenance, and cloud architecture consume another $2.40. General administrative oversight and customer support operations carve out another $2.10. Legal compliance and overhead take $1.80. After subtracting these direct operational expenses, the platform is left with a pre-tax operating profit of just $7 on that initial $35 fee revenue, representing an operating margin of 20% on recorded revenue, but an overall operating return of just 7% relative to the total underlying order value of $100. Now examine the pure-play brokerage or light marketplace, best illustrated by eBay. These platforms explicitly choose not to build or manage physical fulfillment centers, sorting facilities, or delivery fleets. Consequently, eBay records an average aggregate take rate of 13.8%. On a $100 transaction, eBay recognizes $13.80 in net revenue. Because eBay does not physically handle the package, its direct cost of revenue is significantly lighter, with payment processing costs and server bandwidth eating up roughly $2.90. Buyer protection guarantees, dispute resolution programs, and trust reserves absorb approximately $1.20. However, because light marketplaces don't control delivery speed or unboxing experiences, they can't rely on shipping convenience alone to retain consumers. They're forced to spend aggressively on digital performance marketing to continually pull shoppers back into their search ecosystem. Out of that $13.80 in fee revenue, user acquisition expenses through Google Shopping, Meta ads, and affiliate publisher payouts consumes approximately $2.80, representing over 20% of total revenue. Corporate overhead and continuous software development take another $4.10. Ultimately, the operating profit for eBay lands at roughly $2.80 from that $100 sale, leaving them with an operating return of just 2.8% relative to total transaction GMV, despite appearing to operate an asset-light digital network. Finally, evaluate the fully managed cross-border model, which has disrupted traditional Western pricing dynamics. On a $100 retail purchase made by an American consumer on a platform like Temu, the platform operates as the merchant of record, collecting the full $100 directly from the buyer. However, its cost structure is completely inverted compared to domestic operators. Temu pays the original Asian manufacturing facility approximately $30 to produce the physical merchandise. Next, express air freight transport across the ocean combined with domestic last-mile postal delivery inside the United States devours $35. To achieve explosive market penetration and top App Store rankings, Temu engages in an aggressive digital advertising blitz across social platforms, spending an astonishing $35 on user acquisition and ad impressions for that single transaction. After accounting for localized customer service, returns processing, and payment gateway fees of $2.50, the operational return on that $100 sale lands at negative $2.50. The platform deliberately operates at a catch loss on individual transactions, relying on massive corporate treasury reserves to fund market share expansion in the bet that future density and scale will eventually drive down unit transportation costs and marketing acquisition fees. When you analyze these three financial cascades side by side, the harsh realities of marketplace unit economics become unmistakably clear. For platforms that take on physical fulfillment, fixed property leases, warehouse automation equipment, and human labor forces absorb more than half of every fee dollar collected. For platforms that attempt to stay asset-light by avoiding physical logistics, the structural savings are largely redistributed directly into the auction systems of global digital advertising networks to purchase user attention. And aggressive cross-border platforms, customer acquisition, and air freight logistics consume virtually the entire gross transaction value, transforming growth into a highly capital-intensive race for market domination. This dynamic introduces one of the most perilous operational forces in modern commercial enterprise, known as the capacity trap. In the e-commerce marketplace sector, capacity traps emerge along two primary vectors: physical infrastructure capital expenditure depreciation, and digital traffic acquisition cost inflation. The first major capacity trap is the physical logistics capital expenditure trap. Constructing a modern, highly automated fulfillment center equipped with advanced robotics, automated storage and retrieval systems, high-speed sorting conveyors, and climate control requires an investment ranging from $150 million to over $250 million per facility. When a marketplace platform commits to building out a nationwide fulfillment grid to guarantee one-day or two-day delivery, it incurs immense fixed operational costs. These include multi-decade real estate lease liabilities, continuous equipment depreciation schedules, software maintenance licensing, and core labor overhead. During peak seasonal quarters, specifically the Q4 holiday shopping period, these massive logistics grids operate at near maximum capacity, generating strong operational leverage and healthy cash flow. However, during normal off-peak periods in Q1 and Q2 of the year, physical order volume routinely drops by 20 to 35%. Because the underlying facility leases, machinery depreciation, property taxes, and baseline facility management costs are entirely fixed, the platform's unit fulfillment expense spikes dramatically on every package shipped during low-volume months. If overall GMV growth stalls or contracts even slightly, those fixed infrastructure commitments turn into a massive drain on corporate liquidity, dragging consolidated net margins down at an alarming rate. The second major capacity trap is the digital traffic ad auction treadmill. Conversely, marketplace platforms that opt out of building physical fulfillment must continuously source new and returning buyers from external traffic channels.
Because digital search engines and social media networks sell user attention through real-time bidding ad auctions, marketing costs are directly tied to competitive bidding pressure. When novel, heavily funded cross-border competitors enter the North American market and deploy billions of dollars into digital ad networks, the cost per thousand impressions and cost per click rates across digital platforms increase sharply across the entire retail sector. As digital advertising costs rise by 20 to 40% across the industry, pure-play marketplaces find that their historical customer acquisition costs are permanently altered. For a platform that spends $35 in ads to acquire a customer whose lifetime gross profit contribution is only $28, every new user added to the platform erodes enterprise value. To survive this dynamic without sacrificing top-line volume, asset-light platforms are forced to continually raise fee structures on their third-party sellers, creating severe seller friction and incentivizing merchant migration to alternative sales channels. To establish a durable break-even baseline and avoid these financial traps, an e-commerce marketplace must enforce two uncompromising operational efficiency thresholds. First, its physical fulfillment network must consistently maintain an average annual warehouse storage space utilization rate of about 75% to ensure fixed lease costs are properly distributed across unit volumes. Second, its software network must achieve an organic repeat customer rate exceeding 60%, meaning that more than 6 out of every completed transaction must originate from buyers who open the app or website directly without clicking on a paid advertisement. If a marketplace fails to clear these two efficiency hurdles, its business model degrades into a capital drain, where expanding transaction volume simply accelerates cash burn. If core transaction commissions are consumed by physical logistics and marketing acquisition, how do the world's most valuable marketplace businesses manage to generate tens of billions of dollars in real operating profits and free cash flow?
The answer lies in a radical strategic realization that transforms modern retail economics. The primary connection between a buyer and the seller is not the profit engine. It is merely a low-margin loss leader designed to build massive user engagement and physical volume. Once a marketplace platform secures scale and establishes daily transactional density, it activates 4 hidden high-margin profit engines that entirely rewrite its consolidated financial statements. The first and most lucrative profit engine is the retail media network, or on-site seller advertising. When a marketplace achieves tens of millions of active monthly buyers searching its product catalog, its search results page becomes the most valuable digital real estate in commerce. The platform then implements auction-based bidding software that allows third-party sellers to pay for top search placement through sponsored product listings and brand banners. The financial power of a retail media network stems from its near-zero marginal cost. Delivering a sponsored search result alongside an organic result requires virtually no additional computing power, no warehousing labor, and no shipping expense. Consequently, net operating profit margins for internal marketplace advertising routinely exceed 60 to 80%. Amazon generated over $46.9 billion in advertising revenue in a single operational year. This single line item contributed over $30 billion in pure operating income, effectively offsetting the vast operational expenditures of Amazon's physical retail and delivery networks, and transforming a break-even logistics business into an extraordinarily profitable enterprise. The second profit engine is mandatory fulfillment service monetization. Rather than offering warehousing and delivery as an optional convenience, platforms structure their search algorithms and consumer trust badges to favor merchants who utilize the platform's proprietary logistics infrastructure. By locking sellers into programs like Fulfillment by Amazon or Walmart fulfillment services, the platform converts fulfillment from a cost center into a massive recurring revenue generator. The marketplace buys shipping capacity from global ocean carriers, air cargo lines, and last-mile couriers at massive wholesale volume discounts, sells those logistics services to third-party merchants at standard market rates, and captures the financial spread between wholesale cost and retail pricing. The third profit engine is structured subscription services and recurring account fees. On the consumer side, platforms offer premium subscription programs like Amazon Prime or Walmart Plus, charging users a predictable monthly or annual fee in exchange for fast delivery, video content, and exclusive discounts. In 2023, Amazon collected $40.2 billion in subscription services revenue.
This creates a high-margin cash inflow that arrives at the start of every billing cycle, completely insulated from individual transaction volumes. On the seller side, platforms collect monthly account subscription fees, custom storefront rent, and specialized seller tool package fees from millions of active merchants. On Amazon, professional sellers pay $39.99 per month just to maintain an active selling account, while Etsy charges fixed monthly fees for specialized seller tool packages. The fourth profit engine is financial services, merchant cash advances, and working capital float. When a buyer completes a purchase on an e-commerce platform, the consumer's credit card is charged instantly, and cash enters the platform's bank accounts immediately. However, under standard merchant service agreements, payouts to third-party sellers are delayed by 7 to 14 days to account for return windows, order tracking verification, and potential fraud claims. At any given point during the operational year, a large marketplace holds billions of dollars in unreleased merchant funds, known as float. In a standard interest rate environment, yielding 4 to 5%, managing this multi-billion-dollar float in short-term liquid treasury instruments yields hundreds of millions of dollars in net interest income with zero inventory risk. Furthermore, because the marketplace possesses complete, real-time algorithmic visibility into every seller's daily sales volume, refund rates, inventory turnover, and customer satisfaction scores, it can act as an exceptionally low-risk financial lender. Programs like Amazon Lending issue automated working capital loans directly to high-performing merchants, deducting daily loan repayments straight from incoming transaction settlements. Because the platform controls the seller's sales ledger and cash payouts, default rates are extraordinarily low compared to traditional commercial banking, generating lucrative interest spreads for the platform. To observe how these operational principles and profit engines manifest in actual corporate accounting, we can look directly at the audited SEC Form 10-K annual reports of the primary marketplace operators in North America. Let us examine Amazon Incorporated first. According to recent Form 10-K disclosures, Amazon generated total annual GMV across its global ecosystem exceeding $700 billion, with consolidated net revenues reaching over $574.8 billion. Of that consolidated revenue, third-party seller services accounted for over $140.5 billion. When analyzing Amazon's segment economics, their North American retail operations generated $352.8 billion in net sales, delivering an operating income of $14.9 billion, or an operating margin of 4.2%. However, the hidden driver of Amazon's corporate balance sheet is found in its advertising services line item. Amazon reported annual advertising revenue exceeding $46.9 billion. Because the cost of sales for software-driven search advertising is minimal, analysts estimate that this single line item contributed over $30 billion in pure operating income to the parent enterprise. Paired with $90.8 billion in high-margin cloud infrastructure revenue from AWS, these digital engines generate the vast majority of Amazon's net cash flow. Now, turn to eBay Incorporated, which presents a completely different financial profile in its Form 10-K filings. eBay reported annual gross merchandise value of approximately $73.3 billion, generating net corporate revenues of roughly $10.1 billion. This reflects an effective aggregate take rate of approximately 13.8%. Because eBay operates entirely under an asset-light model, delegating all physical storage, packing, and shipping directly to its sellers, its cost of revenue was just $2.2 billion, or 22.2% of total revenue. This light operational structure enables eBay to generate a solid operating margin of approximately 21.7%, producing $2.2 billion in operating income on $10.1 billion in revenue. However, the structural limitation of eBay's model is visible in its growth metrics and marketing costs. To maintain its customer base without offering native fast delivery guarantees, eBay spends $2.05 billion annually on sales and marketing, representing 20.3% of its total net revenue. Furthermore, its overall GMV growth declined by 1% year over year, demonstrating that while an asset-light marketplace can harvest strong short-term margins, it struggles to capture new market share against platforms that own physical logistics. Next, consider Etsy Incorporated, which focuses on craft, vintage, and creative merchandise. In its SEC Form 10-K disclosures, Etsy reported annual GMV of approximately $13.2 billion and net corporate revenues of $2.7 billion. This yields an exceptionally high overall take rate of roughly 20.8%. Etsy achieves this high monetized rate by layering multiple distinct fee components: a 6.5% baseline transaction fee, a 20-cent listing fee per item, payment processing fees of roughly 3% plus 25 cents per order, and an aggressive mandatory off-site ads program, charging 12% to 15% for sellers exceeding $10,000 in annual sales. Despite capturing more than 1/20th of every transaction dollar in platform fees, Etsy's consolidated operating margin sits at roughly 13.8%, yielding $375 million in operating income. The primary drag on Etsy's profitability is its heavy dependence on external performance marketing. Etsy spends over $745 million annually on marketing, consuming more than 27.5% of its entire top-line revenue. Because handcrafted and vintage items are non-standardized, Etsy cannot easily build automated batch fulfillment centers. As a result, it must continuously repurchase its audience through external digital advertising, leaving its net profitability exposed to rising online ad auction prices. Finally, analyze the financial disclosures of PDD Holdings Incorporated, the parent enterprise of Temu. In its consolidated financial reports, PDD Holdings demonstrated explosive top-line revenue growth, reporting annual revenues of $39.9 billion, representing an 89% year-over-year revenue increase. Transaction services revenue, which includes Temu's cross-border operations, surged to 241% year-over-year to $15.9 billion. To drive this rapid international expansion, PDD Holdings allocated $11.6 billion to global sales and marketing across its operations in a single operational year, consuming 33% of its total corporate revenue. Servicing orders from Asian factories to North American consumers requires air shipping expenses devouring $35 on a $100 purchase. Financial analysts estimate that Temu incurred operating losses exceeding $3 billion on its international operations, using cash flows from its domestic Chinese marketplace business, which generated over $15 billion in consolidated operating profit, to subsidize its global expansion. To synthesize these complex corporate filings into a clear operational picture, we can compare the underlying parameters of these four major platforms. Amazon relies on a heavy logistics hybrid model, processing $700 billion in GMV with a 35 to 40% seller services take rate, accepting low retail operating margins between 3 and 6%, and driving corporate profitability through its $46.9 billion internal ad network. eBay operates a pure light marketplace, capturing a lower 13.8% take rate, achieving strong operating margins of 21.7%, but reinvesting 20% of its revenue into ad acquisition while facing flat GMV trajectory. Etsy targets a customized product niche with an elevated 31.8% take rate, but surrenders 27.5% of its revenue to external ad channels to maintain traffic, leaving a 13.8% operating margin. PDD Holdings uses a fully managed cross-border architecture, spending over $11.6 billion globally on user acquisition and air freight, sacrificing immediate unit margin to aggressively capture market volume. When you examine the structural reality revealed by SEC Form 10-K filings, the ultimate lesson of the digital commerce sector becomes glaringly obvious. The business of running an e-commerce marketplace is fundamentally misunderstood by casual observers. It is not a modern version of traditional retail trading, where profits are made on the simple markup between wholesale cost and retail price. Instead, a successful e-commerce marketplace is a complex exercise in managing multi-sided network dynamics, operating high-volume physical distribution logistics, and controlling proprietary digital advertising ecosystems. The physical connection of a buyer with a seller and the subsequent packing and shipping of the box is merely the foundational requirement to earn customer attention and achieve transaction volume. The platforms that win the long-term war for digital market dominance are those that treat the physical transaction as a neutral entry point, leveraging that volume to build an ecosystem powered by high-margin retail media networks, mandatory logistics monetization, subscription memberships, and financial services float. Sellers and buyers think they are participating in a simple online market, but under the surface, they are participating in a massive software-driven media network, a logistics clearinghouse, and a high-yield financial institution disguised as an online shop. Understanding these underlying economic realities is essential for anyone evaluating, building, or investing in digital commerce enterprises. Top-line transaction volume and impressive gross margins mean nothing if those revenues are consumed by logistics liabilities and digital ad auctions. Long-term commercial survival requires mastering the transition from transaction fees to high-margin platform monetization, transforming low-margin retail activity into an unassailable financial flywheel.